familiar with the Economic Club Miami. We are a relatively new organization. We were started in 2021 during the pandemic. We now have over 200 members. We're a membership organization. We promote thought leadership as well as networking. And this is the Miami Economic Forum, our annual international finance conference. And so I really want to welcome everyone today. For those who are returning from last year, as well as those who are here for the first time. So thank you so much for coming. I know many people have traveled from very far, so we're very appreciative for everyone to come today. And for those who don't know me, I'm John Hartley. I'm the founding chair of the Economic Club of Miami here. There's a few of my co-founders who are here as well, and we have our executive director, Francisco Gonzalez, who's put in a tremendous amount of effort today for today's event. So really grateful for all their work on this. And by way of background, I'm an economist. I host a podcast at the Hoover Institution, the Capitalism and Freedom in the 21st Century podcast. And do a lot of economic stuff, and very looking forward to today's conversation, and very much honored to have distinguished members from the Federal Reserve here today. It's my distinct privilege to introduce to you Governor Adriana Kugler. Dr. Kugler took office as a member of the Federal Reserve Board of Governors in 2023 to fill an unexpired term in 2026. Prior to her appointment on the board, Dr. Kugler served as the U.S. Executive Director at the World Bank Group. She's also on leave from Georgetown University, where she's a professor of public policy and economics and was the vice provost for faculty. Previously, she served as chief economist at the U.S. Department of Labor from 2011 to 2013. Dr. Kugler is also a research associate at the NBR and the Center for the Study of Poverty and Inequality at Stanford University. Dr. Kugler's other professional activities also include being the chair of the Business Economics Statistics section of the American Statistical Association, was also a member of the board on Science, Technology, and Economic Policy at the National Academy of Science, and served on the Technical Advisory Committee at the Bureau of Labor Statistics. Dr. Kugler also received a BA in Economics and Political Science from McGill University. I grew up in Toronto, so it's wonderful to have a fellow a Canadian connection there, and also a PhD in economics from the University of California, Berkeley. I'm a Stanford economics PhD. There's sort of a famous rivalry between the two schools, but we won't hold that against her. But without any further ado, I want to welcome Governor Kugler to the stage to present some remarks that she's prepared, and then we're going to do a fireside chat afterward. Thank you so much. If you could please give her a round of applause.
Well, thank you so much, John, and thank you for the opportunity to speak with you today. I have to say, it's such a pleasure to be back in Miami, a city that I have seen grow and become ever more dynamic over the decades, as I have come here many times to visit my very large extended family here in Florida since the 1980s, and I have some of them here with me today, so I'm so glad. I have to say that it's also a real pleasure to be here at Miami-Dade College, an institution, the largest Hispanic-serving institution in the nation, and an institution that, as I understand, has offered economic mobility and opportunities for so many here in Miami. So thank you for inviting me to do this speech in particular here today. As I discussed in my last speech of 2024, there are two positive supply shocks that have significantly benefited the U.S. economy over the past 2 years. And they have also affected our conduct of monetary policy. The first of this has been the surge in population over the past few years that has helped to bring labor supply and labor demand into balance. And this, in turn, has also helped inflation move towards FOMC's, or Federal Open Market Committee's, 2% target. The other positive supply shock, which I outlined in my remarks in December, has been a step up in aggregate productivity growth since 2020. This has allowed productivity growth to help again the economy and to help us reach our 2% target. Although productivity growth is measured quarterly and it can be quite volatile, over the past 5 years, this acceleration is quite evident. While productivity grew by about 1.5% between 2005 and 2019, in 2020, and starting in 2020, the economy and productivity has grown at about 2% a year. This difference between this 1.5% between 2005 and 2019 and 2% after 2020 may not look all that dramatic, but because of compounding, and you all know about compounding here, year over year, right? The consequences of a 0.5 percentage point in growth can have really big effects, not only for workers, but on the economy as a whole. When workers are more productive, it really means that businesses can produce more without needing to add more workers, and that they can also pay workers more without needing to raise prices. When they're more productive, it can also serve as an incentive to expand businesses. Across the economy, higher productivity growth means that real wages and living standards for workers can rise faster without putting upward pressure on inflation. And that is exactly what we have been happening during this period, when inflation has been falling while the economy has been expanding. While fast growth in wages was one of the factors driving inflation in 21 and 22, most likely some of that increase was due to productivity, and hence it was not really inflationary. If productivity continues to grow at this accelerated pace, it would support the FOMC's efforts to keep unemployment low and return inflation to a sustained level of 2%. For that reason, I would like to spend the balance of my remarks exploring some of the possible reasons why productivity has accelerated and the prospects that this fortunate development will actually continue moving forward. Numerous factors affect aggregate productivity, and several may have driven the increase in productivity growth here in the US since the pandemic, in contrast to the subdued productivity growth experienced in other advanced economies around the world. One factor may have been the result of enormous movement of workers caused by the pandemic that we saw. It all began, if you remember, with the dramatic loss of 22 million jobs in the spring of 2020. The reemployment of many of those workers and the continued mobility as people quit jobs, you remember the Great Resignation, switch occupations and careers, and relocated in response to the enormous changes in work and home life brought about by the pandemic. In finding new jobs, in what became a very tight labor market, workers had the opportunity to find better matches for their skills and, to some extent, work that they were motivated to carry out and for which they were also more productive. One indication that this was probably a significant factor in the US is that other advanced economies where there was less worker mobility have experienced lower rates of productivity growth. In fact, economic data and research suggest that periods of a strong job reallocation are accompanied or followed by higher productivity growth. The tightness of the labor market since 2021 has also likely led firms to invest to a greater extent in labor-saving as well as labor-enhancing technologies, which of course is traditionally one of the major sources of productivity gains. For example, many retail businesses, as you well know, seem to have installed more self-checkout machines after the onset of the pandemic, allowing employers to substitute capital for workers when workers could not come to work in person and when there were in fact severe shortages. More generally, digital technology allowed employees to continue working from home during the period of the pandemic and beyond, saving commuting time and making employees potentially also more productive. To the extent that these factors are boosting productivity growth, they're by their nature one of developments that will eventually fade away. A notable exception may turn out to be productivity improvements from investments in artificial technology. AI investment by businesses has really stepped up in the past years, and it appears to be accelerating indeed. The advent of the internet and related innovations boosted productivity growth for about 10 years, starting in the mid-1990s. And the benefits of AI could potentially be that revolutionary and persistent as well. Time will tell. In addition to being temporary, the factors that I have outlined that could be boosting productivity include job reallocation and technological investments are themselves hard to measure across the economy, and also their effects on productivity. But there is another important factor that is likely to be driving productivity higher, whose effects may very well persist, and that is the surge in new business formation experienced since 2019. As I will explain, new businesses are associated with higher rates of overall productivity growth, and that may be particularly true for some of the sectors in which these businesses were created. Applications for new business tax identification numbers jumped shortly after the pandemic began and have remained elevated since then. In 2024, the pace of applications that are likely to result in employer business formation was about 30% higher and above what the pace was in 2019. This surge is largely unique to the US. In the Eurozone, for example, business registrations have been relatively flat. This may help to explain why labor productivity growth in Europe has been well below that of the US in recent years. The surge in applications in early 2020 was an early signal of an acceleration in the formation of job-creating new firms. The latest data available indicate that new firms created 1.9 million jobs in 2023, 14% higher than the total for 2019. A couple of aspects of this surge in business entering the US are really noteworthy. First, the surge was particularly noticeable in high-tech industries that historically are important for overall innovation and productivity growth. And second, while the pace of business applications has cooled somewhat over the past year, it still remains elevated and well above pre-pandemic norms. It is in fact proving to be somewhat more persistent than many expected. For these reasons, the surge in new business formation is highly relevant to our discussion of productivity. There is a large body of research to which I have contributed that finds that new firms are key contributors to innovation and growth in aggregate productivity. This might seem surprising and counterintuitive, maybe, since it is well known that new firms fail usually in the first year or two. But in the commotion of competition that many new businesses face, there are always businesses that persist and keep their lights on, and those often do so because they are innovative and more productive. New businesses are the essence of the competition that drives market-based economies, and it is not surprising that they would be an important source of new products or processes for doing business and a source of growth themselves. Of course, not every new firm has to innovate and grow to make an important economic contribution. Every entrepreneur contributes, even if they just create a job for themselves or for their families. But those new firms that do innovate and grow are indeed critical for improvements in overall productivity over time. As I have noted before, Since the surge in entrepreneurship after the onset of the pandemic featured an increase in high-tech businesses as well, the productivity implications could be really significant. Indeed, the last period of strong productivity growth in the US, which ran from the late 1990s to the early 2000s, was preceded by a surge in new business creation in high-tech industries, including those industries that more recently have been associated with AI-related developments. So this is one source of my optimism about continued robust productivity growth in the US. But it is not only the innovations produced directly by new businesses that are important, since by any measure, these new firms are a small share of total businesses. New businesses also help drive innovation for existing businesses. As they scramble for funding, customers, and human capital, new businesses will increase competition for existing businesses, forcing them to innovate as well so that they can actually succeed. This is surely also driving the recent acceleration in productivity growth. Many predicted that the surge in new business creation would disappear as the effects of the pandemic have faded. But this has not really happened, as I mentioned before. It is possible that the surge in entry will recede and that its productivity effects will likewise be temporary. On the other hand, the productivity gains from a surge in entry could last for some time, since these highly productive young firms have been found to grow rapidly for several years, as I have found in my research, contributing in turn to aggregate productivity growth along the way. Time will tell, but for now, it seems likely that this is a factor supporting productivity growth at a higher than historical rate. I will confess to you all that it is not a coincidence that I have come here to Miami to highlight the role of entrepreneurship in innovation and productivity growth. Miami and the Miami metropolitan area is an extraordinarily entrepreneurial area, a place with high rates of new business creation, and it is likely an important source of the recent productivity surge. Imagine, out of the more than 900 US cities for which we have data, Miami's post-pandemic new firm entry rate ranked 8th in the nation. Congratulations to you. And Miami is not alone in Florida. 5 of the top 20 cities for pandemic-era business formation are here in our state: Miami, Tampa, Fort Myers, Orlando, and Destin. Miami specifically, and Florida generally, has been a key part of the US entrepreneurship story for some time. During the decade before the pandemic, Miami actually ranked 5th out of the more than 100 US cities for firm entry rates, and Florida featured 8 of the top 20 US cities. Miami is really special in this regard. I just wonder what you guys do to the water here. Or perhaps it is the sunshine, which has been a long associated with optimism. Or perhaps it is the friendly economic climate, as my own research shows. I have found that policies that facilitate business entry and support worker job reallocation are indeed helpful for dynamism and productivity. But another interesting question for me, as the first Latin person at the Board of Governors since its creation, is whether the large Hispanic population in Florida is also a factor behind the impressive pace of business dynamism that I have just described. More than 25% of Florida's population is Hispanic, compared to 20% for the US as a whole. Nationwide, recent data indicate that Latinos account for a dominant and rapidly growing share of new entrepreneurship in the US, with a particular increase since the pandemic. Of course, many of these Latino entrepreneurs are also immigrant, another group with a well-known proclivity for entrepreneurship. They're immigrants in Miami from the Caribbean and from all over the world who contribute to the entrepreneurial culture of this city. And it is surely this culture, as much as the efforts of any nationality or group, that is the real engine of the dynamism here. I applaud you all for fostering that culture here in Florida, which is such an important contributor to the economic growth of the nation. More entrepreneurs means more productivity, which in turn means higher prosperity for the US economy. Let me now conclude with an outline of my views on the outlook for the US economy and the FOMC's efforts to return inflation to our 2% target while maintaining a strong labor market. Real gross domestic product, or GDP, continued to grow at a solid pace. The BA estimates that real GDP grew 2.3% in the fourth quarter of 24, and private domestic final purchases, which is the best indicator for GDP 1 quarter ahead, grew at a solid 3.2%. Therefore, I anticipate a solid GDP growth also in the first quarter of this year. In addition, early today, the Labor Department reported that US employers created 143,000 jobs in January, and that the unemployment rate actually edged down to 4%, consistent with a healthy labor market that is neither weakening nor showing signs of overheating. Inflation has fallen significantly since its peak in the middle of 2022. And in September, the FOMC judged that it was time to begin reducing our policy interest rate from levels intended to strongly restrict aggregate demand and put downward pressure on inflation. We reduced our policy rate by 100 basis points through December, but the recent progress on inflation has been slow and a little uneven, and inflation remains elevated. There is also considerable uncertainty about the economic effects of proposals of new policies. Going forward, in considering the appropriate federal funds rate, we will watch these developments closely and continue to carefully assess incoming data, the evolving outlook, and the balance of risks. So thank you very much again for the opportunity to speak with you today.
Governor Kugler, for those excellent remarks. We're going to begin our fireside chat here, and for those, I guess one small update. This is going to be a live. This is a live recording of an episode of the Capitalism and Freedom in the 21st Century podcast, which I, John Hartley, am the host of at the Hoover Institution. It's the official podcast of the Hoover Institution Economic Policy Working Group. Really excited to have this conversation with you, Governor Kugler, and ask you some questions, starting with monetary policy. So the Fed funds target range is between 4.25 and 4.5% after some cuts. I mean, what do you consider to be the appropriate stance of monetary policy right now?
So, there's no magic number. There is no specific number that we're looking for. We look at the totality of the data, and we also definitely look at trends. That, for me, is really important. We don't overreact to any particular number or any specific number. We look at the totality of the data and the trends and how the economy is moving. And the other thing that we look is at forecasts. and any risk that may be coming our way. So given that, as I mentioned, right, 2024 ended at a very solid place, and 2025 is also starting at a very good place. The economy in 2024 expanded at a rate of 2.5% compared to 3.2% in 2023. So a little slower, but it's still the highest growth rate among any advanced economies. So economic activity remains very resilient. Now, let's turn to the labor market. As I said, we got data this morning, and we received good news. The labor market is healthy. It's stable. For some time, the labor market had been cooling gradually. Unemployment increased from 3.4% in April 2023 to about 4.2% sometime in the fall of last year. But what we have seen is that the unemployment rate has hovered around 4%, 4.2%. It remains stable. Also, something that we see is that there's still hiring going on, even though the hiring rate has gone back to pre-pandemic levels, and layoffs remain subdued. So that gives us hope that there is a balanced labor market, as I mentioned in my remarks, that is neither weakening nor overheated. The labor market is stable, which gives us a little bit of time to make decisions. By the same token, I have to say, in the past few months, we have seen the inflation rate moving sideways. It has firmed a little bit. So we're paying attention to that. If we look at the overall inflation, whether it's headline or whether it's core, it has moved sideways. Specific components have made progress. So I want to acknowledge the progress that we have made, for example, in terms of the housing inflation component, in terms of services inflation, which had been persistent for some time. But at the same time, non-market services inflation has increased due to portfolio management categories and things of this sort. And then we are making less progress in terms of goods inflation, which has usually kept a lid on inflation as a whole. So that's holding us, a little bit at the same level without allowing us to make progress. Because we're not yet at the 2% level, that means it makes sense to hold our federal funds rate where it is now. And the final issue is, as I mentioned, we have uncertainty coming ahead in terms of new policies that may be put into place, in terms of some policies that have already been put into place, but that we're not sure how they will shape up once they're implemented. So I think the cautious and the prudent step is to hold the federal funds rate where it is for some time, given that combination of factors, given that the economy is solid, given the fact that we haven't achieved our 2% target, and given the fact that we may have uncertainties and other factors that may be pushing up inflation or may be reducing output and growth into the future.
So my next question was going to be on inflation. And so, there's been, some, the Fed's engaged in a few cuts and is now halted, sort of with the latest inflation rate going a little bit sideways. As you said, year-over-year inflation is now 3%. Core inflation is a bit higher at 3.2%. I mean, where do you think inflation needs to be before thinking about any further accommodation or rate cuts?
So again, I'm not one that has a magic number in mind, right? I will keep looking at the trends. I will keep looking at where the economy is going and at the risks ahead. Now, you're right. We have made tremendous progress since the height of inflation in 2022, in the middle of 2022, when headline inflation was 7.2%. It is now 2.6%. If you look at core inflation, it has halved from 5.6% in 22 to 2.8%. But in recent months, we moved sideways. It's really firm. So we want to make sure that we continue to make progress. This talks to the trends issue, right? That we continue to make progress and continue to slow down inflation to feel comfortable with also changing rates farther. That's not where we are right now. I am concerned about goods inflation increasing a bit from minus 0.6% last year to now minus 0.1, so we're not getting as much help from goods inflation. Again, this non-market component of services inflation is not helping us either. But the bit of good news is housing inflation, which had been very persistent. It was at around 5% at the beginning of 24, came down in the fourth quarter to 4.7%. The services component, ex-housing component of inflation has come down to 3.2% at the end of last year after being at around 4%. So there is some progress in some components, I would say, but I am paying attention to why these other components are kind of moving backwards now.
And it's a great point. Inflation was at this basically peak of many decades, and we've come a long way in the past few years. I want to talk a little bit about the balance sheet. The Fed's balance sheet today is closer to about $7 trillion from its peak of $9 trillion just a few years ago in the post-pandemic period. How do you think about the Fed's balance sheet, and where should it be if you think that there should be some terminal level?
So, as you well remember, during the last two recessions, the 2008-2020 recessions, we, and I wasn't there at the time, but I have to say the Fed deployed balance sheet tools to help make progress on revitalizing the economy at the time. And I think that served the economy well. In 2022, in March 2022, the Fed then decided to start reducing the size of the balance sheet. And that has been happening ever since. And I would say that what the Fed, what we aim for, is to reduce the balance sheet to a point that serves us in terms of our effective functioning of monetary policy, given what is now an ample regime system that we have. Now, we're paying close attention to any indicators of the conditions in money markets, because what we want to see is that we're somewhat above this ample level to feel comfortable with stopping this reduction in the balance sheet size. And we don't have any specific date. We're watching very closely, but we don't have a date in mind as to when that may happen. We're just continuing to watch very closely.
So as a nerdy economist, I love asking questions about R star. R star, it's this, it's this level of the interest rate that's neither inflationary nor disinflationary, and there's all these different estimates for it out there in the literature. We have model-driven estimates from Laubach-Williams, which is R star kind of falling further since the pandemic, and also surveys out now from the New York Fed, which ask questions of market participants and their forecast for where they would think the short-term rate will be in the long run, effectively asking about R star. That median estimate or forecast from the New York Fed survey of professional forecasters has actually been rising quite a bit since the pandemic, and other measures show R star rising as well. The median forecast being around 3% from that survey at Laubach-Williams is, I think, closer to below 2% now. I mean, do you have a particular estimate you like to use for R star?
So I use a wide range of models to inform my opinions about R star, but I also look at economic conditions generally. I also look at the financial conditions index to see the level of restrictiveness of our policy rates as they stand. For those, and I know there are a few students here who wonder what this R star is, the neutral rate of the interest rate is basically the interest rate that will keep us at 2% without the labor market either weakening or overheating, and without any shocks. So it's a theoretical concept because we're going to continue to have shocks, believe me. So it's kind of a long-term concept where we would like to be, but it's a theoretical concept. So that's why we have these models. And I rely on a variety of models. I definitely look at the Laubach-Williams estimates, which is a semi-structural model, as well as many other semi-structural models. There are the reduced form models. There is a number of them, Negro et al. And Liebach and Matthews. There are quite a few of them. So they have a range of estimates. But besides looking at these estimates, something that I pay a lot of attention to is the determinants of R star. Why that neutral or long-term interest rate may go up or down. So the reason why I do that is because I want to be paying attention to whether these determinants or factors that affect R star are permanent or temporary. And so that will make a big difference. And so one of the things that I and many others pay attention to, including Constance here, who's nodding and going, of course, is government debt, right? So government debt has been going up, and this government debt means that we need to issue and supply more U.S. Treasuries, and that increases our star. So I think that's here to stay for some time, right? That's pushing up our star for sure. The other thing is what I talked about in my speech, productivity. So productivity also pushes up our star. So as you have seen, I'm a productivity optimist, but there are others that are not as much. And time will tell, as I said, right? We'll have to see. If that remains, that will push up our star. There are many other factors that could push our star down, in fact. So one of them is the aging of the population, which is happening across the world, not only here in the US, but all across the world. When the population ages, people save more, and they invest in safe assets, so there is greater demand for things such as US securities. That pushes down our star. Other things that may push down our star is international demand for US Treasuries. And that has been going up for some time. As you know, there are many countries around the world, including Latin America, which deregulated financial markets, financial flows have increased. That would push up star. That would push down our star also because there is greater demand for US Treasuries. So, you know, there's a combination of factors. If you ask me, I would say our star has gone up some, but not as some others predict. I think there is some momentum up, but I would say there are other factors that are keeping it down. It's still at a level not as far from what it used to be. So I'm paying attention to that because as we move on towards normalizing our federal funds rate, we need to pay attention to when we stop. We need to be close to that R star. So we're not quite there yet, but we all pay attention to that. And my colleague, President Bostic, who's here from Atlanta, pays close attention to that as well. We are all definitely keeping a close eye on our star, and we all have our estimates.
Well, I think you're in good company with you know, our star. You're thinking that our star may be on the rise. I love the fact that the New York Fed, along with the Bank of Canada, Bank of England, European Central Bank, they now put out these surveys asking you know, professionals about their estimates of our star. So not only do you get to, and obviously they look at these models as well, but you also sort of get some information in terms of what people are thinking about R star. I have a whole paper on this. I'm very invested in survey estimates of the natural rate of interest for full disclosure. But I do think it's kind of a methodological step forward because sometimes these models can be very structural, very complicated to understand, and at least being a sort of empirical research person, I appreciate sometimes just asking people what they think rather than having to go into a very deep model. I want to talk a little.
That's really true. I have to say I do like looking at the surveys as well, and there's survey-based models, right, which use the survey data to inform where I-star is too. So thank you for mentioning that.
Exactly. Yeah. And you know, it can still coexist with model-based estimates, and I think those model-based estimates maybe inform those those survey estimates. Yeah, I think it's a really understated sort of underappreciated development. I think that's continuing to come out of central banks. The New York Fed actually has been doing this for 10 years, whereas the Bank of Canada, European Central Bank, and ECB, and also the Reserve Bank of Australia have been doing it for just a couple of years now, but they're following your lead, you being the Fed. I want to talk a little bit about the labor market and U-Star a little bit. You are a very decorated labor economist. How do you think about slack in the economy, U-Star full employment? Where do you think we are today versus, say, full employment? Our latest unemployment reads at 4%.
Yeah, you know, the typical way to measure slack is by looking at the unemployment gap or the output gap. So the gap between actual unemployment and what we call the NIRU, the natural rate of unemployment, or the output gap, which is the gap between the total output in the economy and potential output. And those are usually, they're estimates created by the CBO, by the Congressional Budget Office, but we certainly come up with our own estimates of those gaps. Now, I have to say, during the pandemic and post-pandemic period, and especially during the post-pandemic period and this inflationary period that we have been living through, we definitely realized that there were some other measures of slack which were better. So one that I pay a whole lot of attention to is the vacancies to unemployment ratio. So number of vacancies created by employers and businesses over the total number of people looking for jobs. It gives you a better sense of that gap between the total jobs available and the total number of people looking for jobs. That VU ratio has moved tremendously over the past few years. It was 1.2 prior to the pandemic. It reached 2 in May of 2022. And now it's back, the numbers just came out this morning, to 1.1 again. So it's almost 1 to 1. So that tells you something about how the economy is in much better balance, right? In terms of labor supply being balanced with labor demand. Other things I pay attention to are flows. So the hiring rate, the layoff rate that I mentioned before.
The JOLTS data.
Yes, exactly. The JOLTS data from the Labor Department. So I used to be chief economist at the Labor Department. So this was, where I spent most of my time and days 24/7 looking at the labor data, and that includes the JOLTS data. So the hiring rate is now below what it was pre-pandemic. The layoff rate, surprisingly, has been subdued. It had been going up for a while. Now it's leveled off again, but it's remained subdued given the time we're living through, right? So there has been a reduction in demand for workers, but that has come through reduced hirings and not necessarily through people being laid off. And that's good news. That's a good situation to be in because people are not desperate losing their jobs, right? It's not the 22 million that I mentioned before back during the pandemic. So that's good news. One other measure, which again, this shows you how nerdy I am, so I love that you're also like that, is this measure of quits. The quit rate is one of those things that I paid so much attention when I was chief economist because it tells you about opportunities in the labor market, even for those who are already employed. So you all remember the time of the Great Resignation. So during the Great Resignation, people were leaving, looking for jobs elsewhere because there was an abundance of demand for labor. So that gives you an idea of how tight the labor market was at the time. And there is even the wage premium for quitters, for workers, right? How much more their wages are when they leave a job and jump to another job. That tells you how tight the labor market is. That has all gone back to pre-pandemic levels. So that tells you, once again, that the labor market is at a good place, it's healthy, it's resilient, but it's well balanced at this point. It's neither weakening. We saw the unemployment rate tick down this morning, but it's not overheated the way it was certainly a few years ago, which was causing a lot of trouble as well for businesses in terms of having shortages of workers, right, pushing up wages to a level that was not sustainable. So I would say the labor market is sitting at a good place. It's stable, it's healthy, and it's resilient.
No, absolutely, and it's fascinating too just how much has changed in the past 6 months. There's so much worry about the unemployment rate moving up, and it triggered some of these various measures like the SOM rule and some of these other measures, but yeah, it seems like we're in a much better place now, and I think to your point, it can't be overstated how big a shift is going from having 2 job vacancies for every unemployed worker to basically 1. I mean, that was just a massive, massive shift. And I think vacancies, the beverage curve, is something that people I think are starting to pay a little more attention to. So I think that's terrific. I want to ask you just a little bit about the Fed's framework review. I'm curious, what do you think about the upcoming Fed framework review, and what do you think it should address in your mind?
Yes, so we literally just started talking about this with Rafael and my other colleagues in our last FOMC meeting. And I have to say that one thing that I support and approve unequivocally is keeping our 2% target for inflation. In terms of so many other parts of the framework, I'm entering this process with a very open mind. And we're going to have a whole lot of discussion, analysis, papers, and reviews that we will be doing in the next many months. So that's what we're doing now. I do have to say, and this has been told by others, and it's well known, that the last review was heavily influenced by the period between the last two recessions, between 2008 and 2020, right? So much of that review of the framework at the time focused on the zero lower bound, right? On that ability to maneuver potentially if we were hit by a new recession, given that we were very close to the zero lower bound. Or it was influenced by an inflation which was running persistently below 2%, and how to get that up given that we had a flat Phillips curve, right? We thought there was a flat Phillips curve. So a lot of those things is what we were seeing in the last framework. In my mind, the next framework needs to fold in what we have learned from this last period. We learned that we couldn't take stable prices for granted, certainly, right? We had to deal with these very tight labor markets and wage inflation, as well as price inflation that hit levels that we hadn't seen in many decades. So I think we need to fold in the lessons from the pandemic, but also the lessons from the post-pandemic period. Together, again, we shouldn't forget about that period between the last two recessions, 2008, 2020, with persistently low inflation. We should consider as many possible situations that could affect us moving forward to learn from them. And then the other thing, as I mentioned, that we have learned is that I think we can count on many different measures that we didn't used to count on to understand the level of tightness and slack in the labor market or in the goods market, right? So many other things that could be incorporated as well moving forward. So again, entering with an open mind, happy to learn from my wise colleagues around the table, and certainly very committed to keeping our 2% target.
Well, I think that's several excellent points. Certainly, I think the last framework review, flexible average inflation target, is very influenced by the past 10 years of very low inflation, zero lower bound, and certainly I think it totally makes sense that the next framework review incorporates the events of the past few years. And I think overall this time, I couldn't agree with you more that just inflation targeting is sort of the central thing to I think to celebrate and to certainly keep in the framework. It's been around since the 90s, informally, formally, was put in with Ben Bernanke, and I think just in terms of anchoring long-run inflation expectations has been hugely successful. Last question: you're the first Hispanic governor of the Federal Reserve Board. What does Miami mean to you? And I know you have some family here.
Yeah, in fact, I have some family sitting here with me, and so for me, certainly Miami first and foremost means family. As I said, I've been coming to Miami since the 1980s. My late grandmother used to be here, so I was always visiting. We have 4 generations of family members, right? My great uncle, my great grandmother. Now we've moved to 3 generations. The last 2 generations have all been born here in the US. And so for me, it means family and it means opportunities. I feel so very honored to be the first Hispanic person, man or woman, to serve in the Federal Reserve Board. Thank you. I take this role with so much humility and with the responsibility of feeling that I can represent everybody, all Americans across the country, with the work that I do at the board. So how did I end up here at the board, right? I came because I'm an expert in labor markets. I'm an expert in price and productivity dynamics, and that's how I ended up coming to the board, contributing that expertise. But I also bring that perspective of somebody who's a Latina, who's a woman, who's a daughter of immigrants, and that perspective comes across when I make my decisions and I choose to focus on certain issues that are very important for many Americans across the country. So one thing that I spend a lot of time on is not only talking to my family here in Florida and across the country, but also talking to all Americans and meeting with communities across the country. Because I think, aside from the data, and you saw I'm a data geek and I love this stuff, I also love talking to people and finding out about their economic realities and understanding how they're seeing the economy, and them telling me in real time. And that's the difference between looking at the lag data that we get and kind of understanding the realities today and how they're seeing things coming up tomorrow, right? So I would say that's critical for me, that I represent well all Americans across the country. And because I'm an expert on labor markets and business dynamics, being in Miami, you saw it in my speech, is just a real lab and an opportunity to explore these issues in an environment that is very dynamic and very vibrant. So I'm so excited to be back in Miami, as I said, not only to see my family. We're having a huge picnic with about 100 family members, 4 generations, and very excited to get together and hear from them and hear how they're seeing the economy, definitely, but also to understand how people see our future.
Well, I couldn't agree with you more. There's millions of people underlying all these data points, and I think that can't be forgotten and should be remembered. Well, I want to really thank you for all your wonderful government service, and thank you for this wonderful conversation. Thank you so much, Governor Kugler.
Thank you, John.